Hey everyone, this is John Robinson from Blueprint. Today is May 31st, 2023, and this is the monthly asset allocation update video. So we produce this video every month because of our systematic investment process and how the asset allocation changes within the Blueprint strategies based on our trend following models. We also produce a longer form written piece that we call the co-founder's note, and I'd encourage you to take a look at that, as this month we talk about outliers. And specifically the difference in performance between a very small number of stocks year to date in 2023 and practically all other stocks. And when you look at the index performance and you look at market cap weighted versus equal weighted at the S&P 500 level, there is a very large disparity this year. And it's really caused by what we've recently heard it termed as the Magnificent Seven. So 7 stocks driving index returns. And if you don't have exposure to those 7 stocks, your returns are below average as it relates to market cap weighted, but probably right in line with an equal weight index. We feel like the trend following puts you, or at least raises the probability that you will be exposed to the things that are moving and stay exposed to those things with no prediction and no emotion. So if you haven't read that, I would encourage you to do so, and we'd love your feedback on that. So in terms of the asset allocation heading into June, so we are nearly halfway through the year. It's hard to believe. But U.S. equity-wise, and really amongst all the asset classes, there's very little change this month. U.S. equities remain in a rising trend over both time frames, the intermediate term and the long term, as a reminder. And so there's no change to U.S. equities. Foreign developed equities or international equities, there's no change there. We've been fully exposed to those for most of the year, and they maintain a rising trend over both time frames. Real estate will not change, and it's the opposite of the first two. We continue to see downtrends in real estate over both time frames, so no change there. And as a reminder, for many of our strategies, that real estate exposure that has been reduced is handed up or handed off to foreign developed equities and U.S. equities. In terms of treasuries, this is the part of the portfolio that will adjust slightly. So we increased duration last month for the first time in a while, and now we are just going back to where we were, and that is camped out in ultra short-term duration fixed income of the 30 to 60 day and duration variety. Inflation-protected securities will also decrease as their intermediate-term trend flipped back and is now in a downtrend and joins its long-term trend in a downtrend as well. Gold, within our alternatives bucket, exposure will not change, and we continue to see rising trends in gold and very strong rising trends over both the intermediate term and the long term. And then, as I mentioned earlier, when we're selling longer duration treasuries, we're buying very short duration treasuries, and that's U.S. government, mostly T-bills and other ultra short-term products where there's very little duration, very little price movement in response to changes in interest rates. And we will remain there until we get a different picture in longer duration fixed income assets. And as we do, we will simply buy those. And if we don't, we will stay here for really until we do. So when you look at this picture, the picture is very one-dimensional and very simple this month, and that is almost no change. The only change is we're going down in duration in longer-term treasuries and just buying very short maturity U.S. treasuries and T-bills. So key takeaways. There's no change to U.S. equities. There's no change on the equity front at all, as a matter of fact. The Blueprint portfolios will reduce duration by selling longer duration bonds and buying shorter duration ones. And as I mentioned earlier in the co-founder's note, we write about capturing outliers. And we have a motto at Blueprint that basically goes like this: if it's not repeatable, it's not useful. And what we mean is, if you have a process, or if you have a set of criteria by which you make decisions in markets, that process should be repeatable regardless of the environment, regardless of the context, regardless of the speed of markets. It should be your parameters and your model should be robust enough to adapt to whatever market environment is happening. And so often we see investors of all kinds making decisions that happen to be right with no process and no repeatable process behind it. And we just consider that luck. And that's great. Luck can be a great thing, but it's not something that you should bet on. And it's certainly not something that we are going to expose client assets to. So we have a systematic investment process that removes emotion from the decision making. We often say it doesn't remove emotion from us, but it does the decision-making process. And that's where we feel like we have an edge. And then we let the system play out over long periods of time, because the edge in the types of models that we use, the edge plays out over a long period of time. So you have to have discipline and you have to have patience to realize that edge. So with that, we're heading into summer, school's letting out. I know personally my schedule has been crazy with end of school things, recitals, sports, you name it, we're doing it. So I hope you find a chance to relax as we go into the summer, enjoy the beginning of summer, and we'll look forward to seeing you back here at the end of June. Thank you.